Welcome back to the Property Frontline. Today I'm here again with Scott Hochgesang for our Market Watch series. Hi, Scott.
Thanks, Deborah.
Hi. In this episode, as usual, we're reviewing the Australian property market performance up to for data up to the 31st of July 2025. We'll also do a deep dive on more of the intricate parts of the market. In every episode, we also do an in-focus session, and this month we are focusing on an area that I would say is very passionate, or that we're very passionate about, aren't we, Scott? Something very close to our heart: property myths and big lies.
Nose grows, yes.
Yeah, and because it just seems like it is going off the charts at the moment. I mean, there's always myths out there, but it just feels like they're getting a bigger and bigger voice right now. But let's get going. Let me just share my screen. Yes. So, as I mentioned, this is our Market Watch episode for August. So we are analysing the comparative data from three of the most reliable data houses. So that's Cotality, PropTrack, and SQM Research. And so, Scott, would you be able to take us through the reported changes in the market for the first four areas, so Sydney, Melbourne, Brisbane, and Adelaide?
Sure, Deborah. Hopefully everyone likes the format of our summary chart here. Little Property Frontline exclusive there, I think Deborah and the team have put together. We start off with Sydney, as is usual, and 0.8% growth from the CoreLogic Cotality people. Wow, definitely seeing a burst of activity there. PropTrack only had Sydney up 0.1%, and SQM asking data 0.1%. And we will note there's quite a lot of differences in the data sources this month.
Yeah.
I guess just everybody has their own methodology, and SQM is asking price data. The other two are sales price data. Just take it all with a grain of salt. Yes?
Can I just jump in? I think maybe with the name change, there might have been a data set change with Cotality. We would have to speak to that service provider to confirm it. But I'm wondering whether that's where the,
it could be.
Is.
Yeah. And there were some price revisions I did see in one of their reports. So, it is very possible.
Yeah. Okay.
Rolling on to cold Victoria and Melbourne. Melbourne wasn't so cold with the Cotality results, up 0.4%. PropTrack had it up 0.2%. SQM had falling asking prices there. Maybe vendors got a bit too far out ahead of their skis, as they say, and pulling back a little bit. But shifting over to Brisbane, a strong 0.7% jump from Cotality. Not quite as high, but close, was PropTrack at 0.4% and SQM on the market 0.5%. Down to the land of churches, which had a good month here, as you can see, a strong 0.7% growth rate coming out of Adelaide, even higher number, 1.0% in PropTrack for our Adelaide fans out there, seeing a bit of a resurgence there in that market. SQM, interestingly enough, had asking prices down 1.2%. Back over to Deborah to take us through Perth and the others.
Okay, so Perth, good month, up by 0.9%. PropTrack had it up by 0.3%. SQM, the forward-looking mark, has asking prices up by 0.5%. Hobart, Cotality had a drop of 0.1%, like not much change at all. PropTrack up by 0.2%, and SQM asking prices down by 0.2%. And Darwin, let's talk about Darwin in a second. But look at the difference in the reporting here. It's almost like PropTrack went, what? Darwin up by, nearly 3%. That must be wrong.
Must be outliers. Throw out the data.
Anyway, so Darwin, Cotality has house prices up by 2.9%, PropTrack has no change, and SQM has asking prices up by 2.6%, Canberra up from Cotality by 0.6%, and PropTrack down by 0.2%, and SQM with asking prices up by 1.2%, and that national price, maybe we should have it in there. Anyway, let's not talk about that. Right, and so now onto the trend line. So this this trend line marks the percentage change in up or down of month by month house prices. And for me, being a visual person, not necessarily like, numbers in a table, this works better for me. So we can see, we hear a lot of the economists talking about convergence. So it's almost like the different areas are now almost falling into lockstep as to their percentage change in direction, except one of these. Which one is it, Scott?
Is it spiky Darwin?
Yeah, it is Darwin. So let's just have a bit of a chat about that. Yeah, so talking about Darwin and actually our views from our various front lines, what we actually see in the market. So, like when Darwin started to spike, it was like all of us were going, like, what's going on up there? Because it's such a small market. And so it's one of those situations where just a couple of little good months in sales sends things percentage-wise through the roof. But it's been consistent probably for about the last 6 months, and I really can confirm it is nuts there. Speaking to the agents, they are doing that thing that we saw in a couple of the other areas of the country a few years ago, where property would come onto the market. They were lucky if they got it through for one viewing, and then the agents would just sell straight after, sell on the Saturday if they had the open on the Saturday, and like you can hear like the panic in their voices. But like, what's my view on it? I just don't like. It hasn't got legs. It's just like when Hobart went ballistic, it was like people maybe chasing some bargains, but that's not going to get you anywhere in the long term for, for capital growth and good rental return. And also what we're seeing as we come into the spring market, stock is still tight, but from the existing property space, we are seeing more and more people at opens. So what's your view of what's actually happening?
Over in the new property land, just a couple of tidbits I'll drop in Brisbane, sort of following what has happened on the Sunshine Coast and the Gold Coast, we've just seen an absolute purchase up of all available land. Investors really kind of lining up just to get anything they can at any price point. For the very first time, I've started looking in estates where we've got to wait, 9 or 12 months to get a block. And it means you're talking almost 2 years to complete a project. So, land developers are reacting by putting up their prices, obviously. and there has been quite high price growth there on the land side of things. Just, switching notes down to Melbourne, it's been the opposite in my space.
Yeah.
There are very large rebates available from developers. There's actually a big event coming up. I think it's either this weekend or next, maybe next. Oliver Humer are having a Black Friday sales event, which you rarely see in property. But they got about 7 land developers together, and they've all discounted their blocks of land between $20,000 and as much as $40,000. So,
Wow.
for home buyers down there that can do a bit of studying and camping out, and you've got a place you want to buy and maybe a chance to come in and pick up a block at a bit of a bargain that maybe in 12 months won't be there. But it certainly is a sign of not any real strength in some of the markets down there.
Yeah, you've got to be very selective.
Mm.
Yes, which is the case in, every time you buy. Okay, so back to our slide. Right, so looking at the rental market data on the house side, over the last 12 months, Darwin, leading the charge there, rental increases of just over 6%, and Melbourne coming in at the bottom there with just 7%. Scott, do you want to talk about units, your favourite?
Oh, yeah, certainly on units. Well, Darwin, you got Darwin unit rents up 9%. So clearly that surge is flowing over into the unit side as well.
Yeah.
More growth than I would expect in some markets like Perth, and Adelaide and Brisbane for units. But that really is just a sign of how high house rents have gone up there, or where there's just a push of people into units where many of them would have preferred to have the larger properties.
Yeah.
And in general, this is all helping our inflation stats. I think we're seeing, slowing rental increases. Certainly, I'm advising a lot of our clients to be realistic as their leases come up for renewal.
Yeah.
You've got a good tenant, maybe don't go for top of market. I always like to keep my increases slightly below that to keep a good tenant in place.
Yeah.
And maybe the days of these 10% plus rent increases are quite a ways in our rear view mirror at the time.
Yeah, vacancies all around the country are still low, but yeah, we are seeing this moderation in rents. Okay, so on to the next component. So mentionable news. So this is news that will highly likely have impacted the property market and buyers and sellers' perception and influenced behaviour. So first of all, this week, the RBA voted unanimously, the board was unanimous in dropping the cash rate by 0.25%. So now we're at 3.6%. We have heard that the banks just were very quick in passing it all on. You can jump in if you've got anything to say, Scott, but I'll just whiz through the list. So the Economic Roundtable, this is the economic discussion think tank that the federal government is hosting in the next couple of weeks. And of course, they've been doing all this research, and that has been leaked and just put out there. It's gone into some of the media. One of the biggest things was there was a bit of hype that negative gearing and capital gains tax might be on the table, and then Albo came out, I think only earlier this week, and said there's not going to be any tax changes that we will take or that we will action without taking them up for a vote. And so there should be no changes to those things until the next federal election. This next thing, 50% of voters rely on government for their main source of income. Now, I've added this in here because a client of mine asked me about it, but they had actually got the news wrong. They said, is our Australian economy more unstable? I heard there was this story that came out. It was actually published in the AFR, right, where my client thought that the story was 50% of employees were getting their income from the government, but the story was actually from a piece of research designed for the Economic Roundtable, and it was actually 50% of voters rely on the government for main source of income. So that's, all the people on pension, but what it was actually highlighting, if you actually look at the story, it showed the blowout in the NDIS expenditure, which is massive. And so there's, all these people who are receiving government money because they're providing those sorts of services.
Yeah.
Yeah. Okay. New Zealand lessons. So a few years ago, the New Zealand government dropped, or they withdrew negative gearing, and that did have an impact on prices. So property prices dropped, but we are now starting to see a resurgence in the price of New Zealand property, partly because of the drop in prices. The New Zealand government reintroduced negative gearing. But Scott, you have some more insights onto this, don't you?
Well, there were some planning changes introduced as well, and I will call it the Peter Tulip method on steroids here.
Yeah.
Where they changed many planning controls in the capital cities to allow people with houses on large blocks to easily turn them into duplexes or townhouses literally within 10 kilometers of the city centers. So you can imagine how many new properties could get built in a short period of time if that were to happen in one of our capital cities. And its effect on pricing was to put more supply into areas of the city people wanted to live in. So I think we blame that fall in the New Zealand house prices to both those factors, both a lot of supply and those negative gearing changes.
So that's the reason why it dropped. But now the reason why it's resurging is because they're saying that people can, split their properties or build more. And so now it's increased market activity. Yeah.
Well, yeah. Well, I mean, the properties you can split up would have increased in value, obviously, because now you've got a duplex site for your house.
Yeah.
So that would play into it as well.
Yep. Okay. All right. The other thing that happened over the last 4 weeks was the federal government finally got back to work. So Parliament sat the first time it did. The Labor government pushed through their promise of reducing everyone's HEX debt by 20%. So hopefully that makes things a little bit easier for those with HEX debt to actually access loans. And also, we've talked previously about the change to the Queensland contracts, where from the 1st of August, this extra new pile of information is now provided with the Queensland contracts. But what's actually happened is now there's this big backlog, because before a seller puts a property on the market, they're required to get, council documents and a lot more information that I used to have to hunt for, but now it's provided. But what's actually happened is it's overloaded. It's come at the busiest time of the year. Yeah, it's overloaded councils and it's overloaded solicitors. And so, there's a bit of a crunch. But really, for anybody, go on.
Sorry, Deborah, I was just going to say, in reality, though, it's bringing Queensland up to New South Wales standards, isn't it? It isn't like this is something massive they need to get over. It's just bringing their standards up to really where most states are nationally.
Well, actually, we did a review. So it's New South Wales, Victoria, to some level, ACT do it, but the others are free range. Let's not talk about contracts, but anyway. Yeah. I do have a lovely contract compass module in the Buyer Success program, but, I'll talk about that later. So the point is, anyone who is buying in Queensland at the moment, you are not, you should be provided with the seller's disclosure disclosure statement before you sign any contract. And if it's not provided or if the information is incorrect, you can withdraw even if you're past the cooling date. So even if it's like 1 minute to settlement and you find out that there's something that has been provided incorrectly, plus there's a few other conditions, then you can withdraw. So they really need to get it right, and there's a big incentive. But then, like the other thing I was asked about this week, over the past 4 weeks, the US recession.
Yeah, and a quick report from Trump land here, because I hear from many of my American friends about what's going on there. It feels like the fear of recessions have receded.
Yeah.
The U.S. stock market has hit all-time highs. I certainly have had many family members ringing me up to let me know it's all happy days. Obviously, the Trump tariffs have not been as bad as what people would have thought, in part given his pullback from some of those larger numbers, and just the AI and tech boom there is, I think, something that's hard for us to fathom. The amount of money the big seven are spending building data centers. It's certainly something I think Australia is looking to play a role in that market. I've heard some rumblings about how we could be a big data center hub for this part of the world in Asia. So we'll see if our business leaders can get together and maybe copy the US and make a play there as well. Anyway, it's looking pretty good, and a rate cut's coming from the Fed in September, and Trump may fire the head of the Fed before he's done. We'll see what happens.
Oh, that's so funny. Okay, alrighty. So on to our favourite topic. So this is our In Focus segment. And this month we are talking about property myths and big, big lies. So really it comes down to certain players in the market who will spin things usually just to get a headline, get your attention, get buyers or sellers' attention, and then, distract you off down a rabbit hole. But we're here to protect you. So here's the truth. The number one myth and big, big lie, 100 plus properties is a good financial freedom target. So we say it here often, but number one, advisors pitching this are really just lining their pockets, not yours. So it will cost you every single time you buy a property. So doesn't it make sense that you want to be more efficient with that, and you'd want to reach your financial freedom target buying fewer properties? Like, that's certainly what we do at Property Frontline. Is that what you do, Scott?
Certainly, I'd rather be managing 5 myself and deal with it myself than have 10 little small ones out in regional areas that cause me so much paperwork. I actually have to hire a manager now to stay on top of my portfolio. So kind of very, very similar thinking there, and you can get to these goals with, in some cases, 5 properties in capital cities, maybe 8 out in regional areas. We have clients that are doing it with a couple of houses and a few dual income properties. You might only buy 2 rooming houses and you've got 10 tenants and just a large amount of rental income to live off of. So really, we just encourage people to dig in and focus on the actual numbers, the dollar values of these properties and their portfolio, not that number of and what you see people bragging about out at the pubs.
Yeah, and so it's really the rental income return that you want to focus on. That's more important than the number of properties. And it's really easy to be excited by owning so many, but the smarter people know that you don't need that. And particularly it's much easier these days, given the rate of rezoning we have, where you can just buy one property and, rezone it into many more. And then you're not paying all those stamp duty fees, all the solicitors' fees. You want to avoid spending, all of that kind of money. So efficiency is important. Next, over to you.
This one is me. So, negative gearing is a bad thing for first time buyers. I think we see this out in the media. Everybody wants to attack negative gearing, and we just wanted to give a bit of a counter position here. Just some things to think about. Negative gearing is actually keeping rents lower out in the marketplace. There's plenty of studies that show that. And those first home buyers are actually out renting. So it is helping them save up a deposit to get into the market. Without negative gearing, their rents would be a lot higher. So even if there was some small decrease in property prices, they won't have been able to save up the deposit anyway.
Yeah. And of course, you won't get that message because a lot of the publications just really like telling this other story. When the truth is, and like with facts, that it's actually helping first-time buyers. But anyway, back to you.
Yeah, look, in our research, I actually was not even aware of this, that negative gearing's been in our tax system since 1936.
Yeah.
And it was actually set up after the Great Depression to get investors to invest in properties. So to stimulate the economy, provide rental properties. So it's been there all of that time. And it applies to all investments out in the space. So if we carved off property and we said it doesn't apply to property, it's just going to push people into other alternative investments like shares. So first of all, we're pushing them into riskier spaces to begin with. But secondly, we are now cutting back on investment in the space where we are in so need of it. There have been some historical tests of taking this off. Paul Keating took it off in 1985. It did coincide with, let's say, some increase in rents. There's a little bit of back and forth on whether those two are directly linked, but we can certainly say it did happen. And there was enough pressure that they basically reversed those changes in 1987, and we've got the current environment we have today.
Yeah.
Property investors are paying a lot of tax. We pulled this off of an ABS report. It's just kind of a shocking number because of the $800 billion, I think, in tax revenue in this country, $45 billion was coming from property.
Yeah.
So they are supportive of a large chunk of the economy and of our government budgets and also of our employment base.
Yeah.
Probably one of our largest employing industries in this country is the construction business and all the businesses related to property. So look, just wanted to give a kind of a counterpoint there that it's definitely not all bad for first-time buyers and some things to think about when you read those media stories.
Yep. Okay. Sounds good. Okay. Myth and big lie number 3. Hotspot lists are a good guide for where to buy. Oh my gosh. All right. Number 1, why is this not true? The lists are too generic and not specific to individual circumstances. So usually they might just be saying, Byron Bay is really going off, but can you afford to buy in Byron Bay? Or maybe you're interested in properties where you can add, some potential to it, or properties where you can split the property. So it's no point just chasing a suburb without knowing what types of properties are within that mix. The numbers are out of date. They always are out of date, because when I buy a property, I buy at, I'll sign a contract, and that's the price on that date. And then it might be 6 to 8 weeks before that sale is registered as a settlement, at settlement. And so that's the data that they're supposed to base their hotspot list on. And by that time, things might have cooled down or, kept going. So, it's useless. Out of date.
I'm just going to chime in here with a point there and pat Debra on the back. She's told me about a few suburbs she's been buying in over the years, and I just have always been shocked that they're ones that really people weren't in yet. and they became quite popular. Quite a
Yeah,
ways after the time when you were buying in there. I'm just thinking of ones like Deception Bay and certain ones in Newcastle.
yeah,
So it really is doing your research out there early and understanding the fundamentals and not just following the herd into a spot, really
yeah,
trying to move in there based on, the numbers and get in early.
yeah. So keeping going with the dot points though, these hot lists, they create this momentum where it'll have poor investors chasing short-term spikes in markets where they have longer-term low growth, like mining towns or something stupid like that. The other point is that really often, particularly if you're paying for a list or if the research is being presented to you with a property that someone's trying to sell you, the data analysis can be, I would say, is highly likely to be biased. And yeah, if the list is being sold, like there's so much free, good, reliable information. You shouldn't be paying for a hotspot list. All right, and past sales. Number one, past sales are not a leading indicator of future growth. So to Scott's point, where we've done well for our clients by going after the leading indicators. Is there a lot of families in the area? Is there a lot of employment in the area? Is there shorter days on market and a lot of interest and forward momentum? And the other one, of course, is the government spending a lot of money? Because the government has to be about 10 years ahead of big population growth. But anyway, right, on to the next one. Over to you.
Number 4, always buy in the cheapest suburb you can find. Basically, we see a lot of this, people advertising very low price point regional suburbs, racing in to get properties in the 300,000s often, and they're getting stuck in quite low growth areas. Debra, I think you see quite a bit of this. Maybe you want to chime in.
Well, yeah, there's no point buying or, chasing something that is 300,000 where there's no hope of anything more happening to it. And I'd go, I don't want to name names,
Yeah.
but areas where it's in the middle of nowhere and you can't see a connection point coming.
Yeah, basically a very short price growth. And I think the one thing we both agreed on is we would change this a bit to say buy the cheapest property in the best location you can get. So we want to change the focus more toward location, and away from just cheap properties anywhere.
Yeah, and like you've said, this is often confused with the really good advice of buy the cheapest property in the best street.
Yes, exactly.
Which really, that works. All right. Myth and big lie. Number 5, renovating always adds value. So renovating, close to my heart. Love it, love it, love it. But not every renovation pays for itself, particularly if it's overcapitalized or done without an understanding of the local market. So no point, adding a second story to a house where that kind of property isn't desired. Many buyers mistakenly assume that every upgrade boosts resale value. It doesn't, when in reality it can shrink the buyer pool. So you just need to be nuanced. That's not to say that if you buy into a good area, and we've got a lot of great renovation suburbs in this country. So anything that's over about 25 years is a pretty good renovation suburb. But You've got to look at the property and look at how you can do it within the numbers, and don't spend too much money on flashy things. Even and I know you get this a lot, Scott, with granny flats. I'm going to buy this property, I'm going to put a granny flat out the back. But like now, it costs around about 150,000 to put a granny flat on your property, and you might be better off keeping that money and buying something else rather than putting the granny flat on the back. I always say the approach with that, granny flats have to be used once you've got your foundation property, so once you've got your portfolio and you're coming back to optimize, so you've got all of this equity and it's time to do that. So but I think with the renovating, it's not only what you do to the property, but you have to like match it up to what's happening in the market. So this idea of, which a lot of marketers do, they'll say, oh, it's all about flipping, but flipping, if you try to, so you buy in, do your renovation, then try to sell when the market is relaxed, you're going to pay for it. Like, it's not going to be good. So, yeah.
Yeah, I think the property flipping people are often targeting these kind of cheaper suburbs as well. And there isn't as much upside with the renovated property. I mean, if a flipping strategy were to work, it's going to be in a much higher end capital city suburb where you just add a lot of value from that renovation and sell it to somebody who's just going to make an emotional purchase. And, most of the people that are taking these courses are not out buying $1 million to $1.5 million properties to be able to do that.
Yeah, it's a very good point. Yeah. Where it does work is usually in those $2 million older suburbs. They buy in for $2 million, put say 3 or 4 into it, and you can put it back on the market for maybe 3. But you got to do research. All right. And so, is this one me?
And I think this one's me. So you'll hear this a lot, never ever sell, hold your property till death. And look, I've actually caught myself saying this about property I own as well. I think you need to be strategic here, and not be beholden to one particular line of thinking. Review your properties annually. Look at the markets that you're in. What's the growth potential for the next coming years? Be thinking about, can I reinvest in, another market, a much better property? We do see a lot of people that come to us and they have bought a unit in capital cities and they've gotten low growth for a number of years, and they're thinking, should I ride it out? And I think in many cases, when you do the analysis, you will get to the point of saying, that's an asset. I should just take my losses, take my lumps and sell it, even if I lose 30, 40 or 50 grand.
Yeah.
Because the opportunity cost of sitting on that property for another 5 years when you could go out and buy a house that could get you 30, 40, 50% growth is enormous. So, think about it, be strategic, and
Yeah. And did you talk about like reviewing the property annually? Not only the property, but also the market the property is in.
Yeah. And I think I didn't touch on, though, is be thinking about upgrading your properties, because what you can buy right now you may be able to buy something way better in 5 or 10 years. Your income's grown, your portfolio and your wealth have grown. Some people may be shifting from residential into very high cash flow commercial properties. And again, to sell something like that, to get into that much better property you could not afford it 5 or 10 years ago, is always worth considering.
Yeah, that's right. The market is always changing, offering up opportunities. Yeah. All right. Near and big line number 7, the all-in-one service provider. Oh, how many times have I seen this? So very, very busy clients or buyers who are the people that we look after, and they find it easy to be attracted to a service provider who says, I can do it all for you. I can make sure you get the money. I'll get you the property, and I'll also include the conveyancing. But that is an absolute recipe for disaster because you won't have that independent thinking. There's whoever's doing the whole thing will be there to make as much profit as they possibly can, and they won't, they will often tend to be a little bit cavalier with their due diligence.
I think so. A bit too optimistic,
That's
and,
right.
and there's a push toward completing the transaction. And
That's right.
when these people have business interests together, I mean, it is going to be difficult for one of them to put their hand up to the client and say, I just don't like these terms in the contract. I think this is too much risk. But your independent advisor who's not linked into that will, in fact, do that.
Yeah,
So,
exactly. So it's important to have the transparency. And yeah, and what I see very often is people who have bought that way, they've paid too much, then they realize, like they get an inkling, but that, they're too busy to check, or, like what we'll hear often is people will say, oh, yeah, they just made it. It was just, seamless. Yeah, for a reason, because you've overpaid for it. Anyway, and what else? Yeah, and so then like they learn their lesson, and then they come to people like you and me where we we'll work with a range of service providers and make sure that there's other people providing independent advice.
and yeah, in their area. Look, I'll just add one last thing on this. We saw an AI application making the rounds here in the past day, and it was basically doing this. So,
Yeah,
now you have an app that's an AI agent that's offering you one-stop shop, do everything, and it's all the same thing. You just need to avoid these things and do the hard work of interviewing a few people, finding a few trusted advisors, put your team together, and it will give you a lot more protection.
yeah. Okay, and the final one.
This is a personal pet peeve of mine. I see so much of this. It's the big giant checklist people. I have, 100-point checklist, and I've put all my properties through that, and they have come out the highest marks across the board. And in particular, in the new property space, one of the things that we never see is, well, did you include all the properties in the projects when you did your checklist? Or did you only select the ones that potentially had the higher payments to you that fit your model, and those went into the mix? So you're very likely not looking at all the properties in the space. And
Yeah. So yeah, like from my perspective, I see service providers who will really hype the fact that they've developed this really unique market research model. But yeah, it's not a very useful model. And yeah, like Scott was saying, what they will do is if you ask them to put every property that's in a particular suburb even
yes,
into the research, you will find that there's better opportunities, and
absolutely.
yeah, and better buys. And really, it's just a sales method
Yeah,
to
it is.
lull people into this false sense of security. Oh, it just drives me mad because it just rips off hardworking people.
Yeah, I think one
Anyway,
of one of the things you said to me, Deb, in prepping for this was you do have a checklist for properties themselves, and that and,
yeah,
and that is an important thing.
that's separate. Yeah,
Yes, that is a very important checklist. But these generic researchy checklists that you see with all sorts of grading on it, look, I would avoid them or not give them very much weight. I don't do them myself. I have my own measures and things that we are looking for, and I want to make sure boxes get checked. But I will see firms grade these properties with a 9 out of 10, and I'll look at the numbers that they used, and I'll think that's very average. Like that
yeah,
would barely make it above a look in my
yeah,
world, honestly. So,
yeah. Anyway,
beware the big checklists.
yep. Alrighty. So So tips then to protect yourself as a buyer and really as a seller. Always watch out for misleading data. So use trusted sources. There's plenty of really good free methods out there. Cotality, PropTrack, SQM, realestate.com, Domain, all of those sorts of things. Always conduct the financial pros and cons. So, just have if you are presented with a property, think through just, what will happen with that property as opposed to, buying something else that's actually listed on one of the portals, and use criteria that's tailored to your requirements. So what's right for someone else might not be right for you. So that comes down to, are you buying rooming houses work for certain situations, but they don't in others. So you've got to look beneath the surface. And Scott and I are here too, as sounding boards if you need us. So you can find Scott on Facebook. He's you look up Scott Property Coach, and you'll find him there. And also Scott's details will be in the description of this podcast. We also have our Buyer Success Program, which really has been designed for people who want to do the search themselves but want to have the technical resources to be able to filter a property or just double check that you've got everything you need in the contract or that someone's not pulling the wool over your eyes. Okay, so that wraps us up. But as always, we've got some good stuff planned. So next month on Market Watch, we will be looking at the regionals versus the capitals. And this is actually a very, very interesting topic. So you better tune in for that one. If you would like more information, all the details to Rich, Scott or me in the description box. If you've got anything you would like us to cover, make sure you let us know. We're always happy to receive feedback. And apart from that, if you would like to subscribe, click the button. Anything else you think we need to cover?
All good here. Let's hope this winter weather is over. I've had about a minute.
Well, yeah, I'm in Brisbane at the moment, so
yeah,
we're living the dream here.
I'm jealous.
Anyway, all right.
Thanks, everyone. See you in the next podcast.